Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconen, along with Dennis Dick, and we have Jonathan Corpina on the line. He's a senior managing partner at Meridian Equity Partners. How you doing this morning, Jonathan?
Gentlemen, good morning. Happy Friday.
Happy Friday to you there, Jonathan. Right before you got on, we were just talking a little bit about high frequency trading. We talk about that every once in a while on the show. And Joel used to be a market maker down on the floor. I've got market making experience back when I was with Bright Trading as well. We're just saying how the mechanics of the market are quite a bit different than they used to be. If we go back to the floor years ago, you had affirmative obligations. And now a lot of these market makers that are out there now don't have these affirmative obligations. Is that a concern for you, Jonathan, that we maybe have a lot of just automated market makers that aren't obligated to make markets when times are tough?
Exactly. That's kind of why we see a lot of the volatility in our market. So if you look specifically at the market makers down here in the New York Stock Exchange, they still have affirmative obligation. They still have to be at the inside quote a certain period of time. They have to have their layers on the book up and down on the bids and offers. There is that responsibility to being a market maker. When you bring high frequency trading into play, you've got traders who act like high frequency traders, who act like market makers, but don't have that obligation to be there. So as soon as the market turns, as soon as an earnings report comes out, as soon as there's a negative headline or a positive headline, for that matter, those bids and offers very quickly evaporate until the market kind of finds its levels. Well, while it's trying to find those levels, the market makers with the obligation to be at the market are there making markets and trying to add liquidity. So we kind of have these two forces fighting against each other. And once that liquidity exits the market, I think that's when we start to see some really significant intraday swings.
Let's take you back to the May 6th flash crash of 2010. I'm not sure if you were on the floor that day trading or not. I was trading that day too. And I will note that a lot of stocks traded rapidly down. If we looked at Procter & Gamble, fell from 60 all the way down to 42. But on the New York Stock Exchange, so like on the floor, that stock never traded that low. There was market makers that were actually there making markets a lot higher than that. So wasn't it just the fact that that a lot of these flash crashes that we saw happen were on stocks that the New York market was just in a slow market, right? And the market maker on the floor was trying to figure out where to put the price, and the electronic market was still trading at that same time, and they kind of traded around those New York quotes that when the stock was going to actually not trade that low in New York.
Right, that's exactly what happened. I was here that day, and I remember it very, very vividly. There were no trades that occurred on the New York Stock Exchange during the flash crash that were broken for erroneous price. And that's a message that I don't think many people knew or understood coming out of that flash crash. So the market makers were here. There are parameters to their markets where quote unquote back then, speed bumps came into play, where stocks would swing up or down X percentage and hit a speed bump. They'd have to pause, and then the market maker then has to reprice the overflow of that stock coming in. So on that day of the flash crash, that's exactly what happened. We did not stop trading. We did not have to break any trades, and the market makers were here to stand up to their obligations. Now, that market swung pretty far in a very quick period of time. The market makers down here didn't know what was going on, just like everybody outside the building and around the world didn't know exactly what was going on. We knew there was some sort of problem. We knew that there was something that was occurring that just wasn't right. We've all been in the business, a long period of time to know when we see something that just doesn't smell right, it's not right.
Right.
But what was supposed to happen happened down here, and I think we've always stood up to that, and I think that's helped gain market share, and I also think it's helped gain listings.
And applause to New York for not having to bust any of those trades, because on that day I think there was hundreds and hundreds and thousands of trades that had to be busted actually on individual securities. So that's awesome for the NYSE as well.
There were a lot of investors who just didn't know their positions, right? So let's say you had a buy stop order down way lower on the book, and all of a sudden it gets executed, right? You think you're long the stock, you turn around, you sell it out. Well, then a day later, 2 days later, it took a long time to figure it out. 2 days later, people were realizing, oh, well, that bid that I had on the book on INET or NASDAQ, that was an erroneous trade, and we had to cancel that trade. So now they're short the stock,
Yeah.
and the stock is now trading much higher. So it just caused a lot of problems for a lot of people.
What what are your thoughts on the canceling of trades? I mean, obviously this day was, one that maybe you had to do something like this because it was, absolutely crazy that some stocks like Accenture are trading down at a penny. But what are your overall thoughts here on canceling trades? Should that happen?
It's kind of a fine line to tread over, because clearly stocks should not have been trading at a penny, and I think this isn't the last that we've seen of something like this happen. I mean, we see these mini crashes up and down daily in individual stocks every once in a while. If people have if people launch orders into the book, and they don't have the right risk parameters, and they have market orders, and they hit a finger, and they fat finger and it goes in, shame on you. And I think you should have the right parameters set in place on your order management systems that prevent you from doing stuff. And if there is somebody who's out there who has their book layered or has bids below the market and wants to purchase stock at a certain price and stand up for it, I think they should be obligated to be they should be entitled to buy that stock. And do-overs are mulligans are good for golf, but I don't know if in these types of cases where being able to cancel trades is such a bad thing. And now, what's interesting is when we get these kind of trades on the New York Stock Exchange, we're able to slow things down. We're able to take a breath. Common sense comes into play. We're able to actually track down orders. We've been able to, find where an order is coming from and call that trading desk and say, hey, we've got a pending order here of 200,000 XYZ for sale. Are you sure you want to do it? And they say, oh, wow, that's a mistake. That should only be 2,000 shares. Thank you very much. Now, granted, we could have traded that, and buyers, whether they're institutional buyers or whether they're market makers, could have bought that stock at a deep, deep discount and then bounce back up again. But who's going to win in that one, right? At some point, the seller's going to be upset, which is an institution, which is at the end of the day, there is a customer there, a public money. The listed company is not going to be happy. They're going to say, wait a second, what's going on here? I'm listing on the New York to help. So you guys dampen liquidity, dampen volatility, not add to it. You guys should have been there. You should have stood up, or you should have taken the measures appropriate to cancel that trade. So everyone, is going to be upset. The only winner is the person that buys stock and flips it out quickly. But that's not a really way to, kind of make an overall living.
That's a great point you're making, Jonathan, and we've made this point on the show before, is that human interaction can help to stop those fat fingers, those traders that are putting an order erroneously into the system. If you place an electronic order in this market for 100,000 shares and you only meant to put it for 1,000 shares, then once you press the sell button, there's sometimes, no human there if you're sending it electronically, and that order's just gone, and then it just executes against whatever's in the book, correct?
That's absolutely correct. Whether it's 100 shares, 1,000 shares, or 100,000 shares, once you hit go, it goes. And I think that's where human interaction, common sense has to come into play. Listen, we want a fair and transparent market. And in some of the dark markets, some of the dark exchanges, some of the dark pools, you just don't get that. And I was out with some clients the other day, and I was explaining to them. They said, we love trading on the New York, and we love using you guys. And what's your sales pitch that's out there? What are you telling people? And I said, listen, at the end of the day, when the road gets bumpy and there's turbulence, what do people do? They pull their orders out of the market and they send them down to a floor broker. And I think having that human interaction, that human contact, that personal communication, I think just gives investors a sense of ease that there is somebody here who's looking out for their order flow and who can answer questions. When things go wrong, whether it's in our markets or other markets, they call us and they say, wait a second, what happened here? I know I didn't have an order with you, and I know I wasn't trading stock, but what happened here? I'd love to get an answer. That type of information, that type of transparency, I think is just important across the board in our markets.
What are your thoughts on the off-exchange trading? Because off-exchange trading has grown substantially here in the last 5 or 6 years. We went from 18 or 20% of the volume. It's now over 40% of the overall market volume. At what point in time are the markets going too dark?
I think we've gotten there. I don't think we need 60, 65 different exchanges, dark pools, liquidity centers. I'm not saying that New York needs to be the one and only one. I think we should, from 60, should very slowly get that down to 30, should get it to 15. The problem that's occurred here is that we've got too many markets here that are unregulated. And when I say unregulated, I mean the New York Stock Exchange, BATS, NASDAQ, very high regulation associated with them and very high regulatory fees associated with running those exchanges. The dark pools don't have to follow by the same rules and don't have to pay the same regulatory fees. All anybody in my world is asking for is just a level playing field. We're big boys. We know how Wall Street works. All you'd like is a level playing field. Let's all play by the same rules. Let's all have the same filing rules. Let's have the same trading rules, the regulatory rules, the regulatory fees, and the same transparency. Let's have all that, and whoever gets the most market share will win at that point. I think at the end of the day, whoever can really show transparency is what's really going to prevail. There was an article today in the newspaper talking about a fine for UBS. We continue to see these dark pool fines, and we're going to continue to see these dark pool fines where investors were put at a disadvantage. Using an agency-only broker on the floor of the New York Stock Exchange, my interest is your interest. If you're a buyer, I'm not selling you stock. I'm not buying it with you. I am solely representing your interest, and I think that's an important message.
Let's change the subject for a minute here. We're seeing a fallout from the Swiss franc, and I'm not sure if you've been following this, but obviously the Swiss franc had that huge rally against the euro yesterday and against all these other currencies. And now we're seeing one of the big online brokers, FXCM, fall 88% here today on client losses. Margin requirements only 2% for the currency trading, and that's what the real losses are. They're announcing that they might have as much as 225 million in client losses here, and they might not be able to meet some regulatory capital requirements. What are your thoughts here on this?
To put it quite simply, I think what's happened here is that many people, whether they are small retail investors who feel that they can trade currencies to large institutions who know they can trade currencies, many people were caught off guard here, and this action just kind of is a very painful, expensive reminder to people to make sure that you've got your risk covered, make sure you have your positions covered, and make sure you understand that anything can happen overnight. Clearly the activity that we saw there, and that translated into the U.S. equity markets, right, where people, where this headline was an indirect headline that hurt our markets yesterday. Just people were very, very unprepared for this. This was kind of something that flew below the radar for a lot of people, and once that happens, I think you're going to start to see some pain, and that's exactly what's happening here.
Do you think they're going to raise their margin requirements, like the regulators, possibly after an event like this?
Yeah, I think they're going to have to. I think they're going to have to revisit this. Unfortunately, when things happen, you have to do a post-mortem and take a step back and say, okay, well, how could certain actions have been prevented, and how could certain risk parameters have been better put in place? Usually it's after something happens that they really start to look at things. Even when we go back to what we were saying before, flash crash stuff, many new rules and regulations came out from that very expensive learning experience. So yes, I think on this situation here, they're going to have to take a step back once the dust settles and realize what's a better way to approach this.
Jonathan, it's options expiration here today, and that equals a little bit more volatility in the market often, and we've been seeing a lot of volatility here already. How are you looking and approaching this trading day? I'm looking at the early imbalance feed, and I'm seeing a lot of buy imbalances. Now, these things can change very quickly, obviously, on these types of days. What's it look like down there on the floor today?
This is a day that comes up on our calendar that we're expecting. Yes, we're going to see more volume. Our markets overall have seen a lot of volatility heading into the end of the year, and so far this year, there's been plenty of volatility coming into our markets. Yes, you're going to see large volumes. You're going to see large openings. You're going to see large closings. I wouldn't get too excited about large imbalances that you see, in a stock where you're going to see 500,000 a buy. I think that's already been priced into it, and usually there is an offsetting, couple of sell orders or layers on the book that will dampen that type of liquidity to move that stock higher. But yes, for the most part, we are seeing stock to buy this morning, but don't get too caught up in it that that you're going to see a lot of, immediate swings on openings and closes, right? Because this is something that we know about. This is something that traders have prepared for. This is something that portfolio managers have prepared for. So this isn't a kind of a secret that what's going on.
We're on the line with Jonathan Corpina. He's Senior Managing Partner at Meridian Equity Partners, giving us a look from the floor. Jonathan, before we let you go, I just want to get just your general market comments here. We've had a couple V bottoms, one in October, one in December. We have rallied nicely off both of those, kind of coming back to that December low here. Any thoughts on the market, just longer term here? Are the buy the dippers still coming in full force and going to take us right back over 2,000, or you think we might have a little bit more of an extended correction this time?
I think that there were plenty of investors who missed out on that late year rally that we had last year and came into this year waiting to get back into this market. I think they have seen their opportunities to get back into this market. Overall, my overall sentiment is the market is going to move higher. We're going to have a couple of these blips in the road, these unexpected activities like we saw with Swiss they're going to really affect our markets. And clearly, the move that we're seeing in oil has affected our markets. Once we start to see oil stabilize, I think investors are going to feel a little easier getting back into this market. Are we going to move much lower? I don't think we're going to go significantly lower from here. It seems like we continue to bounce off these bottoms here, and overall sentiment from clients I talk to is that this market is going to get back above that 2,000 level. So when we see these dips here, I do tend to see my types of clients that I deal with, come in and start picking into this market, because at some point I think we're going to see this rally like we saw towards the end of the year last year, and those were just missed opportunities.
Okay, Jonathan Corpina joining us on Benzinga's pre-market prep, talking market structure, talking high-frequency trading. Jonathan, we always enjoy having you on, and hope to speak to you again soon.
Thank you, guys. Have a great long weekend. Enjoy the holiday.
Thanks, Jonathan.